Well, hello, potential investors. This is Nick Jones with Jones and Associates here on Jones Financial Talk today. Appreciate you listening in. We've got a lot of great information for you today. If you'd like more information about what you hear on this fine show, you can find that information in two different ways. You can go to jonesfinancialtalk.com, click on the radio page. You can listen to all the previous shows. We've got lots of great content on there that you might be interested in as well. Or you can just pick up the phone here in the Rogue Valley and give us a call at 541-500-4321 to help us figure out any financial topics that might interest you. Today, we're going to be talking about something that many of you own and have, and these are individual retirement accounts, IRAs. And the reason why I wanted to highlight this is there's just so many things that happen around tax time, especially that's come up this year with some of my clients. Reasons and kind of nuances with IRAs that a lot of people might not understand. There's actually quite a few mistakes that are made with individual retirement accounts. And if you think about it, at the end of last year, there was $13 trillion in IRAs in our country. Just a crazy amount of money. So we got to get this right is the point I'm trying to make. I'm going to bring my co-host, Mr. Tony Shore, in so we can discuss lots of these topics together today.
Hey, Nick, thanks for having me on the show. Great to be here. I'm excited about this one. You know what? So many people think, hey, I've got this 401k. I'm going to put some money in an IRA. I'm going to be set for retirement. But so many mistakes can be made. So I'm glad we're talking about this today. By the way, I've had a great week. I've been super busy. How about you? You've been busy.
I have. Yeah, we're about a month away from annual tax filing, and so lots of questions, conversations with clients about how to prepare and make sure that they do everything correctly. And obviously the topic today is what a lot of people talk about, because you have the ability to still contribute for 2023 into the individual retirement account plans that we're going to talk about.
Wow. Okay. That sounds good. Well, let's jump in. I know we've got a lot to cover. I know you've seen people come in and they've made maybe some mistakes with their retirement accounts or their, portfolios and savings. What are some of the bigger mistakes you've seen people make out there?
So the first one that's top of mind, because just at the time of year that we're in here today, Tony, is waiting until the 11th hour to contribute to that individual retirement account. And investors do have until their tax filing deadline, which is usually April 15th, to make IRA contributions, and those can count for the previous year. So for 2023, as long as you put the money in before you file your taxes this year, you actually can still make that contribution. And perhaps not surprisingly to you, many investors take it down to the wire. Some of that is because they don't think about those contributions, or their advisors don't talk to them about their contributions throughout the prior year. And then they go to do their taxes. They're sitting down with their accountant, and the accountant says, hey, do you want to save some money? If you put money into one of these types of accounts, you can save on your taxes for the previous year. And that's a great thing, right? To be able to put the money in there, Tony, but waiting is the key here. And what I mean by that really is, if you put the money in last minute, you are going to miss out on all of the time that the money could have been invested for previously up to that date. So think about it. If you put money in on January 1st, 2023, instead of April 14th, 2024, you're going to have 15, 16 extra months of compound interest on that money. And that's a serious amount of money, especially when it's growing tax-free over time. Does that make sense?
Yeah. Well, it's the power of compounding interest. I mean, the sooner the better. It's the old, when's the best time to plant a tree? 20 years ago. 20 years ago. When's the second best time to plant a tree? Today. It's the same with investing. When's the best time to start saving for retirement? 20 years ago. The second best time is now, but the sooner the better. That is a huge mistake people make. They put off contributing more money to an IRA, and they miss out on all those gains, right?
Yep. And there's a couple of good ways that you can address that. I mean, I realize that some people don't just have $7,000 or $8,000 sitting around that they can dump in, at any given time.
Sure.
And so if you can't dump that full contribution amount in at the start of the year, you could set up a automatic investment program, right? And dollar cost average into your IRA over that time period, which makes sense, and that's just investing fixed kind of installments each month until you hit your limit. That works great for many people. And when you set things up on auto, it's easier to just come out of the account. They don't really miss it. They know where it's going, and it's just kind of part of their budget.
Yeah. There you go. Yeah, have it set up to automatically go in there, and if you do it over time, it is great. Even no matter what, no matter how little or how much, just keep putting money into that account. Every single month, have money, or every single check, have money put directly in there, and because it's if you do it right from your paycheck, you're not going to miss it.
That's right.
And that's the key. So a big one, waiting until the 11th hour to contribute. What's the next mistake you want to talk about that
Probably
people
the
make?
second biggest mistake, and this might come to a shock to some people. First of all, let me back up and say there's two different IRAs that you can put money into. The traditional IRA, where you get the tax deduction up front, the money grows tax free, but then when you take it out, you pay taxes on all of it.
Right.
And then you could put money into a Roth IRA, which also has to be in the account no later than before you file your taxes. And so the Roth account is a hugely beneficial type of account we've talked a lot about on our show. And that's where you put after tax money in. Don't get the deduction today, but you still have to let the IRS know you're putting that money in. And it grows tax free, and you'll never have to take that money out, and you'll never be required to take that money out. So a couple of things with Roth IRAs. One, if you make any income at all and you're going to put money into a Roth IRA or a traditional IRA, you got to file taxes. A lot of people assume, like for instance, my son, if you make less than the standard deduction, you don't have to file taxes, right? Because let's say the standard deduction is 14,000, you make 13,000, you're not going to owe any taxes. You don't have to file taxes, right?
Right.
That's true. However, if you put money into a retirement account, you actually do have to file your taxes because you got to let the IRS know that you're putting money in. Okay. So that's a big thing. But where I was going with the Roth IRA conversation was a lot of people assume that Roth IRA contributions are the best thing to do. I mean,
Right. I mean, you've
so
said on
much.
many shows yourself that you've touted the benefits of Roth IRAs. And I
Yep.
hear that from so many financial professionals.
They've heard so much about all the great virtues of Roth IRAs, the tax-free compounding and withdrawals, no mandatory withdrawals and retirement that we talked about. They might just assume that funding that Roth IRA instead of a traditional IRA is always the right answer. But it may not be, is what I'm trying to say. And for investors who can deduct their traditional IRA contribution on their taxes, their income must fall below, the limits in order for that to make sense. And that's partially because when you get into retirement, your tax rates could be lower than what they are today. And so, the tax break today could be way more valuable than to anybody now than in retirement. And we just don't know how that's going to be, but depending on the income that you have, depending on the assets that you have, your financial advisor should be able to help you figure that out so that you understand which route is better to take.
Sure. Yeah. And that makes sense because everybody's situation is different. All right. So what's number 3? What's the third mistake you want to cover?
Yeah. So the other thing is getting caught up in thinking about IRA contributions as an either or option, traditional or Roth. Okay. And you don't necessarily have to do that. It depends on your tax bracket, like we talked about. But, if you have no idea, it's reasonable to split the difference, half in one and half in the other. Right. And so that way you have a couple of different buckets of money with different tax rules and liabilities. And gives you the ability to have two different types of accounts. And so you don't have to just do one or the other. You can definitely split them. That's the other big thing that people don't think through enough, Tony.
Interesting. Yeah, I guess a lot of people can have more than one type of IRA, and they can have more than one IRA account. It's not an either or, and it's not just one. You have to watch out, right? I mean, there's no reason to have 4 traditional IRA accounts separate.
Right. And then the other thing too is, which I failed to mention earlier, just because you're putting money into a 401k or 403b at work does not mean that you can't also put money into an IRA or a traditional IRA. Okay.
Right. And I've had many, I've heard many, yourself included, say you probably should be doing both.
Yep. Because inside that 401k or 403b at work, you're probably getting a match. But I talk to lots of people locally here that have that match on the 401k side or 403b side at the hospitals here locally, for instance, but they don't have the ability to put money on the Roth side. And so what you do is you continue to contribute into your normal 401k or 403b throughout the year. But then before you file your taxes, if you've got extra money, you open an IRA account, either traditional or Roth, and put more money there. Now, there are income limits that you have to be aware of, and your financial advisor will help you with that, figure out how that's going to work for your specific situation.
Sure. Sure. So what about number 4? What's the next mistake you want to cover?
So this kind of works into the same conversation. So making non-deductible IRA contributions is and can be a mistake that people make. And so why would that happen? So here's what happens, Tony. There are Roth income limits, meaning if you make jointly last year over 230,000, you can't actually put money into a Roth IRA because you make too much money. You earn too much.
Oh, okay.
But you do have the ability to always put money in a traditional IRA. I mean, Donald Trump could put money into a traditional IRA. It doesn't matter how much money you make.
Sure.
The key on the traditional side is the money that you put in deductible or not? Okay, so if your income limit is too high, you cannot deduct the traditional IRA contributions, but the money still can grow tax-free inside that account. It's just a non-deductible contribution. And so while investing in there makes lots of sense, you have to understand that if you do that, there's going to be a couple of big drawbacks. Okay. So one of those is required minimum distributions and ordinary income tax on the withdrawals, because you're going to pay taxes on that. And unless you keep track very, very carefully of the non-deductible side, you're going to pay taxes. And then, the main virtue of traditional non-deductible IRAs, in my view, is that it's a conduit to really use Roth IRAs through that backdoor Roth maneuver that many people talk about, where, the investor simply makes a contribution to a non-deductible IRA and then converts those monies to a Roth shortly thereafter. Why would they do that? Because no income limits apply to conversions.
So that is a way to get around the income limits of a Roth. You can't contribute directly to a Roth yourself if you make over a certain amount of money, but you can contribute to a traditional IRA and then roll it into a Roth.
And convert it is the key. So there's no income
Roth
limits that apply to conversions. That's right.
Uh-huh.
So, you definitely, we're getting into some tax nuances here that you definitely need to sit down and talk to your tax accountant about. Make sure that they know how to file the forms and they're comfortable with it. If they're not, they should be calling your financial advisor and talking to them about it. I talk to lots of accountants this time of year, talking about investments, talking about different types of accounts that we have.
Yeah, helping your clients. You kind of look at the big picture and are looking at their tax situation when it comes to their retirement savings and their investments, and then look over. But then they're working with their tax accountant or CPA, and I know you work alongside them, so that's a good thing to point out. So what's something else we need to be aware of regarding this?
So thinking about that, assuming that a backdoor Roth IRA is going to be tax-free can also be a mistake. Nearly always it should be some type of maneuver that you're doing so that in many instances it is tax-free, because the money that you've put in has already been taxed. And, if the money is, converted shortly after contribution, those assets won't have generated much in the way of gains either. So you won't be paying taxes too much on there. But for investors with, substantial traditional IRA assets that have never been taxed, you have to realize that if you use that maneuver, in fact, most of the time, taxes are what's going to happen. Because they're looking at very specific rules to make sure that you are taking advantage correctly in the tax code. And so there's lots of little rules that the IRS puts in play. One of those is called the pro-rata rule, where they are looking at how much you have in each of these types of accounts and what you're doing to make sure that you are in the spirit really doing what's required of you in the tax code.
Yeah. Yeah, so you do have to worry about that. And again, all these things are reasons to work with somebody like yourself, Nick. So let's take a minute here to let our listeners know how they can get a hold of you. And listeners, Nick, you're offering a no charge, no obligation consultation. They can talk to Jones Financial, give you they can get a hold of you through the website, correct?
Yep. Just go to jonesfinancialtalk.com or give us a call at 541-500-4321. I have many calls a week that I talk to prospects that have listened to the show and have questions and how we can help. And please take us up on that offer.
Yeah, sounds great. Again, the website is jonesfinancialtalk.com, and there's a contact form you can fill out. Somebody will get back to you and tell them you heard about it on the radio. You want to set up that no charge consultation. Now, I believe that we're on number 6. What's the sixth mistake that people need to avoid regarding IRAs?
Okay. So another one, Tony, is not contributing to an IRA later in life. And
Okay.
that's the next big point here, because many Americans are working longer than they used to, right? And in recognition of that fact, the Secure Act just a few years ago removed the age limits on contributions to traditional IRAs. Roth IRA contributions were already allowable for people of any age. But the key requirement is that the person that puts money into this account or their spouse has to have earned income from working income, not from Social Security or their portfolios. They have to have earned income to be able to cover the amount of the contribution that they put
So they
in.
have to still be working.
That's exactly right. And so, making those contributions later in life can be very attractive for investors who don't expect to need the money in their own retirements, but instead are trying to plan to pass money on to their heirs.
Yeah.
If you think about a Roth IRA, for instance, that's a huge legacy tool, right?
Yeah,
You
if you
put
can put money into a Roth and pass it along to your heirs, then they get to take those tax-free withdrawals.
That's right. They never pay taxes on any withdrawals. You never pay taxes on any of the withdrawals or the growth. Okay. And so, they're not required to take money out. Now, there are requirements for your beneficiaries today if you pass away and leave the money. So you have to think about that. But even if there are requirements in the Roth side, really the only requirement in tax code today for a legacy person that inherits a Roth is that they just have to take the money out in a 10-year period. But when they take the money out, it's tax free. They don't have to pay, okay, for the taxes that are sitting there. So you know, I, I think that Roth IRAs in this situation are a great thing for contributing later in life. Traditional IRA contributions, will tend to be less attractive for older adults
Sure.
because you have to take the money out still, right? The required minimum distribution
Right.
there at age 73. So if you put money in when you're 72 and you guys turn around and take it right back out when you're 73, it might not be helpful.
Yeah. That's a good point. At some point, it probably doesn't make sense to keep contributing to a traditional IRA. But if you're still working and you're a number of years away from that yet, that makes sense. So, what's next?
So the other thing here, Tony, kind of going back and talking about this similar thought, um, forgetting about the spousal IRA contribution options. So
Ah,
a lot of people assume that when they stop working, they can't put money in. But remember, only one of the two spouses has to be working. If they earn enough, you can put money into both of those individual accounts. Okay, so it doesn't matter who's earning a paycheck. It's as long as one of the spouses earned enough to cover the total contribution amounts for the two of them, you can make those contributions for both individuals each calendar year. And again, this happens a lot, Tony. Lots of people don't retire at the exact same time, or they're older or younger than their spouse. And so, giving them the ability to save more while one of the spouses is continuing to work sets them up for a couple of different things. Either a more comfortable retirement for themselves, clearly, when they get to that point, or a legacy play, like we talked about, and some type of a Roth account.
so as long as the earning spouse has enough earned income to cover the total amount contributed for the two of them, they can continue, they can make IRA contributions for both of them, even though one spouse isn't working.
That's exactly right. That's
Wow.
exactly right.
Okay. I did
Yep.
not know that. That's interesting.
And
Uh,
remember that that does not affect how much money you put into a company sponsored plan like a 403b or a 401k. This is
wow.
outside of that.
Yeah.
Okay. So, if you're over 60, let's say you're still working, you can put what, $30,000 into a 401k at your work today. And then on top of that, you can put another $8,000 into an IRA for yourself and 8,000 into an IRA for your spouse this year if you make that much money and if you are not over certain income limits. So
Wow.
that's like what, 46,000 dollars that you can put into retirement accounts just this year, that are either tax deductible or just great savings options.
Wow. Wow. And then you get all that compounding interest, which is the thing of beauty. Well, okay. What's another big mistake you've seen out there, Nick,
So
that
the
people make with IRA contributions?
Not getting started early enough. So delaying IRA contributions because of some type of short-term consideration, right? Investors, Tony, especially younger ones, might put off making some type of IRA contribution because they assume that they'll be tying their money up all the way until retirement. But that's not necessarily the truth. We've talked about this before. Roth IRA contributions can actually be withdrawn at any time for any reason without taxes or penalty. And investors may also withdraw, the interest earnings component of their IRA without taxes or penalty under certain circumstances. So, first time home purchase is a big one here that a lot of people come to me and ask about. And so, it's not ideal to obviously raid your IRA permanently, right? But by doing so, it just gives you the flexibility to think about that. A lot of people say, okay, look, Nick, I'm 25 or whatever age they are, and I'd love to put $7,000 into a Roth IRA, but I'm probably going to need that money in a couple of years for something. I use this as an example. I started saving in a Roth IRA very young. My dad was a financial advisor. As soon as I started working and could put money into a Roth IRA, we did. My brothers and I did. And when I was in my 20s, I wanted to propose to my beautiful wife, Logan. And
Nice.
what did I have to do? I had to buy her a ring. Oh, right. I love her. I love her. So, at that point, I wasn't working. We were just getting out of college. And I took a contribution withdrawal out of my Roth IRA to come up with the money for the ring. And I didn't have to pay for any of the taxes because it was originally a contribution that went in. And so I don't want people to feel like a retirement account is a savings account they can come and grab whenever they want. But in certain types of situations, it does make sense because a lot of people don't know what's going to happen. Like another example, I just talked to a younger client the other day. I think I'm going to buy a house in the next 3 to 5 years, but I'm not sure.
Hmm.
Well, if you're not sure, put the money, or if you're not sure when you're going to need it, put the money in there, let it grow tax free. And then if you need to take your contributions back out, you can. You still can. So use it in a different way is what I'm trying to say.
Yeah. But don't make a plan like that without talking to a financial professional whom you trust, a fiduciary like yourself, Nick, because you don't want to tie the money up in a wrong way or get in a situation where if you do need the money, you'd have to pay a penalty, and you can help our listeners out there avoid these mistakes, and they can be costly mistakes. That's why we're talking about them today. And again, they just need to go to jonesfinancialtalk.com. They can check out the website, check out past shows. They can also contact Jones and Associates through the contact form there, give their information, and someone in your office will reach out to set up that no cost, no obligation consultation. Now, what's another mistake we should be avoiding?
Well, thinking about those very specific topics that you need to talk to your accountant about or a financial advisor, one that comes up quite a bit with Roth IRAs is a 5-year rule and how that affects distributions. And so,
So what's the 5-year rule?
yep. So the ability to take tax-free withdrawals in retirement is the key advantage to the Roth IRA. But even investors who are over 59 and a half have to satisfy what's called the 5-year rule. And that means that the assets must be in the Roth account for at least 5 years before they begin withdrawing them. That is a stipulation in tax law. So that's straightforward enough, right? But things
Right.
get more complicated if your money is in a Roth because you've converted traditional assets to it, let's say. So the key takeaway, you got to get some good tax advice if you need to pull money out of a Roth IRA shortly after getting the funds into the account, because if you do it incorrectly, then you're going to be penalized. So the 5-year rule is a big one that comes up. And that's also, a lot of people probably have been asked this question. If you call your financial advisor, or well, if your financial advisor should know, but if you have your money just directly online with a self-directed account, and you say, I'm going to take money out of this Roth account, a lot of people are going to say, well, how long's it been open for? The reason why they want to know that is they want to know if it's been open for more than 5 years.
Right.
If it's been open for more than 5 years, then okay, fine, you're good to go. But if you're not, you're subject to penalties still.
Yeah. You have to be 59 and a half or older, and you have to have had the money in there for 5 years, right?
Yep, exactly.
Okay. All right. That's a big one. And I think that's one some people might not be aware of. What's another one?
So, a lot of people amass just tons of money inside their IRAs. We talked before that at the end of last year, we had $13 trillion in IRAs in this country.
Crazy.
Mad money,
crazy,
as we call it, right?
And most of that's just in your personal IRA, Nick, I heard.
Well, yeah, a little bit of it is here in the
That's
Rogue
real
Valley.
money to you and I.
Yeah, totally.
13 trillion.
13 trillion is real money. Yeah, it's real money. Great point there, Tony. Yep. Thanks for giving that away. But,
Sure.
anyways, so, many investors begin saving in their 401k plans, and they just amass very sizable sums before they turn to an IRA. And, it might be tempting to think of the IRA as, mad money, suitable for investing in very specific niche products, exchange traded funds, cryptocurrency and things of that nature. But don't fall into that trap. I mean, an IRA can indeed be a great way to capture good assets and different types of investments that aren't offered inside your company retirement plan. But they're real money, right? The IRA is going to grow into a very nice chunk of change over the years. So you've got to make sure that you are investing correctly. A lot of people that don't know the difference between these types of accounts, Roth IRAs, traditional IRAs, 401ks, assume that those are specific types of investments. That's not the case. If everything else was equal, the type of account is just the taxation that's applied to that account.
It's just a tax designation.
That's exactly right. You can buy any investment you want.
There, you can have real estate inside that.
Those different types of accounts. You can own the same thing. So a lot of people say, well, I don't want to move money from my IRA to my Roth IRA because it won't be the same investment. You can own the same investment in both.
Yeah.
Okay. So it has nothing to do with what the investment is. It has to do with the tax designation that you talked about. So you just have to make sure that you're being prudent in the way that you're investing that. And that is one thing that does happen. A lot of people come in and they say, hey, I got most of my money, say, 500,000 in my 401k plan, and I got 100,000 in this IRA that I just want to take risk with, and I'm just going to buy some cryptocurrency and other things. And I'm like, well, that 100,000 is just as valuable as 100,000 that's sitting in your 401k. Why wouldn't you consider more sensible options and investments? Is the key here for all of your accounts.
Yeah. Well, we're out of time for today's show. It flew by. We should probably finish. I know you have a number of other things you wanted to talk about today, but time got away from us, Nick.
Maybe we can cover those on the next show, Tony.
Yeah, we'll do part 2 next week on the next show. Nick, before we go, let our listeners know how they can get a hold of you.
Sure thing, listeners. So you can always just go to jonesfinancialtalk.com, request information there, or pick up the phone here in the Rogue Valley. We're at 541-500-4321.
All right. Sounds good. Thanks, Nick. And listeners, thanks for tuning in. That does it for today's episode of Jones Financial Talk with our host, Nick Jones.